All right, you guys ready to go? 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 Alrighty. Hang on, I gotta move everything around. Hang on, I don't know where the chat is. Where'd the chat go? Oh, there's the chat. I guess I gotta pop that. Let's see, pop the chat. Move that down, move this over. All right, I think I got it. All right, let's go. Welcome, everybody. This is a special event. Thank you for attending. We are going to cover non-farm payroll, habit, Federal Open Market Committee. Now, I promised you that between 1:30 and 2 o'clock, I would be able to do a presentation about the FOMC. And, no, hang on. And guess what? The slide is missing. I can't find the slides. So, now if I can move things around, man, things are complicated. Anyways, I have, there we go. I have a recording. I can't find the slide decks. I spent like an hour trying to find the slide decks and couldn't find it. Just couldn't find it. So I have a recording of it. So I'm going to do sort of an encore version. So we'll get on with that. Let me remind you that trading's risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. So we'll just move on over to here. And so here's the encore presentation from a couple of years ago. It's the same slide deck. I just couldn't find the slides. I don't know where they are. They're not anywhere on the cloud. So let's just go. 3, 2. Get on with it. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Okay, so the agenda today, I'm going to teach you everything you need to know about the Fed in 30 minutes or less, and then there's going to be some sort of announcement at 2, and then we're kind of just going to float around for a half an hour, wait for the press conference, and then we'll watch the press conference together as a community. Okay, what do you think about that? KJ wants the long version. Okay, welcome to Forex.Today. Let me remind you that the purpose of Forex.Today is education. This is not alert service. I'm not here to make trade recommendations. However, I will conduct technical and fundamental analysis, and I'll do so in real time, pip by pip. All right, so where are we? Oh, I got to get my la-di-da-di. We likes to party. The Fed. Okay, by the way, look at that. I've made 200 pips since New York today. Since 8 a.m. made 200 and something pips. Nice! Just since this morning. 200 pips raining out of the sky. So anyways, I gotta move. Give me the juice. I gotta move. Give me the juice. All right, so what is the Fed, what is the FOMC, and what in the world is central banking? Trader's Guide to the Federal Reserve Bank. Okay, first of all, the Fed has a dual mandate. You probably know this. They need to keep the economy healthy, but also keep inflation moderate. The economy currently is not healthy, and there is no inflation. So they're not doing a very good job, maybe, right? But check this out. This is different than many central banks, like the ECB, for example. All they do is inflation. But they have very little power to say, Spain, you should do one thing. Germany, you should do another thing. Italy, you should do this last thing. You know, France, you should do this thing. Like, so they can't really, they don't have much power there. Their job is to try to keep inflation in check. But we've found over the years they're not even good at that. Okay, cool. So how does the Fed do this? Well, they have different tools. They can adjust the reserve requirement ratio, right? This is adjusting, this is how much a bank is required to keep at the Fed. They could also influence excess reserves, and this has to do with that deposit rate. And lastly, they do open market operations, otherwise known as OMO. All of this, OMO is specifically monetary policy. So, for example, the money supply is a vertical line. It has nothing to do with interest rates or the amount of money in circulation. Okay? The money supply is the money supply. It's the number of money. So it's not downward sloping like a demand curve. It's not upward sloping like a supply curve. This is just a vertical line because at any point in time, there's just a certain amount of money in the market, okay? The amount of liquidity, right? So the Fed can come in and adjust money supply. So the Fed can buy bonds. So what they do is they call up one of the 11 bond dealers in New York City. So they call up JP Morgan. Hey, what's up, Jamie? We need some bonds, bro. Right? So JP Morgan says, well, we're happy to sell you some bonds. So the bonds leave the balance sheet at JP Morgan and they go to the Fed. It's now sitting on the balance sheet at the Fed. In exchange, JP Morgan gets money. Then JP Morgan puts that money into their bank account, right? The house account, if you will. And then that gets spent. And that goes to someone else's bank account. And that gets spent. And that goes to someone else's bank account. And that gets spent. Okay? So that money that the Fed gave JP Morgan, what that was a gateway to enter into the economy. And now the economy has that money because guess what? The Fed did this. Hey, JP Morgan. Hey, Jamie Dimon. We'd like to buy $100 billion worth of bonds. So they go la, 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 la on the keyboard. And then they simply send it to JP Morgan. 100B. The Fed gets the bonds. And 100 billion is entered JP Morgan's bank account. Okay? Now the other thing can happen where the Fed says, you know what, we need to reduce the amount of capital in the economy, so they're going to sell those bonds that they bought from JP Morgan. They can sell them back. They're like, hey, world, buy these bonds from us. And that's making the balance sheet at the Fed smaller. So the opposite happens. JP Morgan comes in, gets a good deal on some bonds. They buy it from the Fed. Okay? JP Morgan gets the bonds, and the Fed pulls the money out of the economy and destroys it. Okay? And that makes the money supply go down. So you can see they can make the money supply shift to the right, or they can make the money supply shift to the left, either increasing or decreasing money supply. Now, check this out. You may not know this. They do this all day, every day. There's a trading desk at the New York Fed that all they do all day is this, either buying or selling bonds. Okay, now how does this impact interest rates? Because we have an interest rate decision. So if the Fed cuts interest rates, they're going to have to actually do something, because what you also might not know is interest rates are not law. It's not like the President of the United States mandates that interest rates are something. The Fed steps in and they make interest rates. So how do they do it? So here we have the demand for money. That is downward sloping because it's a demand curve. The more expensive money is, the less demanded. So let me draw it this way. If interest rates were 10%, how much would be demanded? Very little. If interest rates are 2%, what would be demanded? A lot. Okay? Quantity 2 versus quantity 1. The difference being, right, interest rate 1 and rate 2, right? So whatever. So the amount of money demanded from the economy is proportional or related to, let's just say related to, the interest rate. So check this out. So here's an equilibrium point, right? At this, when money supply is here and the amount of money demanded at that supply level creates an interest rate. Okay? Cool. Now, then the Fed jumps in and the Fed sells bonds. So what happens? The Fed sells bonds to bond dealers. Bond dealers give money to the Fed. They have reduced the amount of money in the economy. Okay? They have reduced, right? And we get a new equilibrium point, and the interest rate went from interest rate 1 to interest rate 2. You see that? The Fed sells bonds, the bond market falls, bond prices fall, interest rates rise. Interest rates went up. Interest rates went up when the Fed sold bonds. Well, isn't that interesting? Okay, now check this out. This is actually interesting. I think one of these slides is a typo, but let's check this out. Fed buys $10 billion in bonds. The math here is 1 over R plus E times the deposit. Total deposits rate 1 over 0.1, which is the reserve requirement ratio, times 10 billion, right? The 10 billion that the Fed inserted into the market. So the total deposits is 10 times 10 billion. It turns out to 100 billion? Whoa, wait, what? You're like, Wayne, you lost me there for a second. Check this out. JP Morgan sells the Fed bonds, 10 billion in bonds. JP Morgan now gets 10 billion, right? So what do businesses and people do with money? They spend it. So it goes into a bank account. What is the bank going to do? They're going to park 10%. That's what this 0.1 is. This 0.1 is 10%. They're going to, right, which is the required reserve ratio that banks have to have with the Fed. So check this out. 10 billion goes to JP Morgan. The bank now, the bank side of this, not the bond trading desk, but the overall bank then does what? They park 10% at the Fed, they loan 90% out because they're a bank. That's what they do. Which means someone borrows from the 9 billion. And what do they do when you borrow money? What do you do with it? Well, you spend it. Like if you have borrowed money to buy a house. Well, you borrow the money and then you give the homeowner the house and you get the keys to the house and it's transferred. Like you borrow money to spend it. So they lend the money out, which goes to someone else's bank account. Therefore, that bank has to put 10% at the Fed and they lend the rest out, which gets borrowed by someone else, gets parked at a different bank, 10% gets parked at the Fed. And what happens by the time this cycle goes all the way down to like a $1 loan somewhere, it actually gets multiplied into 100 billion being added to the economy. And this is why rich countries with stable banking systems are rich, because of the fractional reserve banking system. You ever notice like a poor country has terrible banks that nobody trusts? Nobody puts money in the bank. What do? They stuff it in a coffee can and put it in their fridge, or they put it under the mattress, or they bury it in the backyard. It never multiplies. It doesn't become a loan to the business down the street. It doesn't become a mortgage for your neighbor. It doesn't multiply. It doesn't grow. It doesn't do anything, and everybody stays poor. Okay? So the opposite can happen now. The Fed instead buys 10 billion in bonds. What happens? The money supply goes up because, right? They buy the bonds, they add the money into the market, the supply of money goes up and interest rates fall. So when the Fed is buying bonds, they drop interest rates. Cool, right? So what is the Fed? Let's keep moving. What's the Fed? History of the Fed. The United States has tried multiple times to have a central bank. They hate it. Why? Because Americans have a certain point of view. Most people that came to America hated the king. Okay? They hated the king. They don't like centralized power. So they get to the colonies and the colonies get independence. And at the end of the day, they're like, the president of the United States is not a king, nor shall we have a central bank that mandates what we do with our money. So they refused to have it for a long period of time. But what happened was a lot of these banks ended up failing because what happens was there's no safety net in the economy. And so when the economy tanked, banks would collapse and then everybody would lose their money. So at some point, someone had to step in. Well, after the third or fourth or fifth crash over the years, guess what? JP Morgan got to the point where JP Morgan, the person, the dude in the white, was the person that actually bailed out, not a bank, not the economy. They actually bailed out, he actually bailed out the United States government at one point. And he's like, whoa, 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 I can't keep doing this. This is stressful, right? So, and which is funny because it was all his dad's money anyways. But, so anyways, he actually got to the point where he bailed out the entire U.S. government. So he says, whoa, 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 we got to change something, right? So he and his big buddies from Wall Street and his big buddies from Washington, D.C., they go down to a little place called Jekyll Island, Georgia, where they used to hunt all the time. And while they were there, they created the Central Bank of the United States. It was actually the third central bank of the United States, okay? Because he was sick of bailing out the economy, and he thought, you know what? It's not I don't want it to be my problem anymore. So this is the first Fed meeting, right? That's the Federal Open Market Committee, okay? Now, they had to get this passed into law, okay? So what they had to do is work the political angle of the situation. So they were worried, like I said, people didn't like centralized power, okay? And they didn't want a system that could be rigged. So imagine you're a farmer in Iowa. Do you trust the guys in Washington, D.C.? Do you trust New York bankers? How about way out in California or Oregon? Do you really want to have your life dictated by some Wall Street a-holes or some corrupt politician in Washington, D.C.? You're like, no way am I going to vote for that, right? So they had to come up with a system. So guess what? The United States doesn't have one central bank. They have many central banks. So here's how it works. Each region in the United States has its own central bank. However, most of the money is staggered in either Chicago, New York, or California. Makes sense, right? Now, each one of these central banks has its own stockholders. They actually have stock, right? And the members of each regional Fed, they elect 6 directors and 3 reps that come from the Board of Governors, okay? The 9 get together and appoint the president with the approval of the Board of Governors, again, out in Washington, D.C. So each Fed has a president. Like Janet Yellen, for example, was president of the San Francisco Fed. Okay? So the 9 directors of each regional central bank include 3 professional bankers, 3 leaders from the business community, and 3 that are appointed by the Board of Governors. Now, the reason for this is they want a wide-ranging view of the economy, specifically their local economy. That's why they got to have 3 business leaders, because the San Francisco Fed should be able to call up Larry Page and say, hey, what's up? How's Google doing? What do you think about the future? Are you going to hire more people? Are customers buying stuff from you? What do you think about the next 6 months? And they gather all this information. They need to know what's going on. So they have backward-looking data, but they're also doing surveys from local businesses to get forward-looking data, okay? So this is a well-rounded overview of this local economy, okay? So what they do is once they have this forward-looking data from all the local businesses, they compile all the data and they put it into something called the Beige Book. Has anyone heard of the Beige Book? Well, guess what? This gets compiled and sent to the Board of Governors so that everyone knows what's going on during the Federal Open Market Committee. Well, how about this Board of Governors? What are they all about? Well, they are in Washington, D.C., so there's like someone that oversees the entire central banking system of the United States. There are 7 governors appointed by the United States of America and confirmed by the Senate, so it's a very political decision. Now, they serve 14 terms, and they rotate, so the president can't come in and just like kind of play a house of cards and move things around and get what they want. So Trump made Jay Powell president. That was a president of the Board of Governors. That was a controversial decision because he's not even a real economist, right? And then what? As soon as he gets elected, now Trump hates him and he can't do anything about it, okay? So it was designed to be just like that. So they have 14-year rotating terms. Each governor must be from a different region. So you can't just have everyone from the Board of Governors from the East Coast and forget the West Coast, right? And then they get together and they elect the chairperson of the Board of Governors. Cool. Currently, Jay Powell, right? So the chairperson of the Board of Governors, this is a very powerful position. They meet with the President of the United States. They deliver press conferences like the one today. They testify in Congress. They actually have power to negotiate and stuff like that. But they're also the chair of the FOMC. And this is what it looks like right now. They're gathering in this room at the Board of Governor building across the street from the Vietnam Memorial in Washington, D.C. Okay? Cool. So check it out. They meet 8 times a year. They set monetary policy for open market operations, the buying and selling of bonds in real time to manipulate interest rates. Okay? All 7 members of the Board of Governors get to vote. The president of the New York Fed gets to vote. Why? Why does he always get to vote? Because they manage the Forex desk, the bond trading desk. They actually do the open market operations. So they always get to vote. Plus they have all the contacts, right? The other 4 of the other 12 get to vote. The other 7 get to talk about things, but they don't get to cast a vote. And guess what? The reserve requirement ratio and the discount rate are not FOMC issues. That's Board of Governor issues, so that won't come up today. Okay, so here's how it goes down. They gather in the Board of Governors office, and they do all their stuff. First thing on day 1. Okay? Or just wait. Okay, so there's the Secretary, Monetary Affairs, gets the speech and all that. All right, let's get to day 1. Number 1 thing they do, they approve the meeting minutes from the previous meeting. 2, the report of the manager of OMO speaks first. The Forex dude speaks first. Why? Because they're the one doing the actual work. Then they get to vote the ratification of the OMOs, and then they tell the Forex guy, okay, go back doing to whatever you were doing. Go back to work. And they continue with the meeting. The Board of Governors staff then do a presentation on the National Economic Outlook. This is called a Green Book. You don't get access to this. So what happens is this PhD comes out and says, we looked at all the data that's been coming in from the Beige Book. We gathered our intelligence, created a strategy, and this is what we think the economy is going to be like now, moving forward in the next few months. This is how we see the economy, okay? Then once that's done, they have some tequila shots, and then they move on. Each president then gives their regional outlook. This is what San Francisco's like. This is what Detroit's like. This is what Atlanta's like. This is what New York is like, so on and so forth, right? But they don't talk about what to do. It's just the state of affairs, okay? Then they go to Applebee's. On day 2, the Director of Monetary Affairs then presents the scenarios. If you raise interest rates, this is what we think will happen. If you don't do anything, this is what we think will happen. If you cut interest rates, this is what we think will happen. And that's called a blue book, which you also don't get, but that gets passed out to everybody. So it's the recommendation, sort of, not really recommendation, but sort of like, if you do this, this is what kind of happens stuff. Next. Then they all get together and they start discussing. The voting and non-voting members discuss. What do you want to do, bro? What do you want to do? Okay. Once they kind of get there, the president starts putting together a statement, right? Right? They kind of frame the language. Then they summarize it. All right, here's what the press release is going to say. The secretary reads out the proposed wordings about their decision, and then they vote. Is this what we're going to do? Yes or dissent? Okay? And then, at 2 o'clock, which is just seconds away, they make their announcement. Then, at 2:30, they do a press conference. Okay? So once again, they conduct monetary policy, they supervise the banks, and they also provide a payment service to, they process your checks. Cool, right? There you go. Everything you need to know about the Federal Reserve banking system in the United States and the Federal Open Market Committee in less than 30 minutes. Woohoo! We're just seconds now away from their actual announcement. So if that was cool, please give me a thumbs up. Could you have that common courtesy, please? Would you please give me a thumbs up for that?
I'd do that if I were me.
They don't teach that at school. Well, I did.
Yeah, I'd love to be a university professor. All right. So here he is. Glad to have you here. What are you going to trade? What's your big thing? Oh, it's absolutely my pleasure. Euro dollar, we can maybe drive into that, go into the 5 minutes, drive in even further. It's kicking off my little bouncy bounce. Okay, Evans, yeah, trade the dollar. Yeah, for sure. So we get about 5 minutes. I keep watching the clock. What I'll do is I'll run CNBC for a second. Aaron says, that was dope. Okay. So anyways, if we back out here, but that's the trade plan that I set Thursday of last week. And so to drop into a 15-minute or a 5-minute, that gives you an idea of where we are. Peter's on the Dow Jones Industrial Average. Really? Not S&P? You do the Dow? Interesting.
Saying in order to make sure that he delivers a message that he's going to remain.
So I have CNBC. I'm going to get slapped on YouTube.
Really tricky, right, David?
I'll probably just take down the video.
The last 2 days we had jolts, right, higher than expected jobs.
But this is live, real time.
Greater than expected number of private sector jobs last month.
No delay.
We're still seeing a lot of strength and resiliency in labor, which then in turn potentially translates to ongoing.
So they have
wages as well,
157.
Well, two things here. First of all, what we've seen so far is that despite an extraordinarily tight labor market, the tightest labor market in over 50 years, we're not actually seeing
look, there's
that
my
strong
book.
wage growth. I mean,
You see
last
it?
month
Look at
the
that.
wages
There's
were
my book.
5% year over year, which sounds high, but inflation was 8.2% year over year. So, in fact, wages are lagging behind inflation.
It's cheaper to trade. Yeah, I gotcha.
You know how hot the labor market is.
You know what, I'll bring up Trader's Way while we do that.
It's just a very bad idea for monetary policy. You've got to be forward-looking. If you wait until inflation falls, you'll have waited too long to stave off recession.
LinkedIn says I should be following this guy, and I'm like, why?
On growth, I think growth will stay positive.
His accent throws me off. I don't know what it is.
Inflation, and I think the Fed will have to acknowledge that in their statement. That there's better news than inflation. The key question is whether we're going to get some indication that there'll be fewer hikes, or there may be some more hikes rather than just ongoing monetary tightening. That's really the question. It's all about the messaging, as Jim said.
Mona, what would those signals sound like to you? That perhaps the tightening phase.
Oh, interesting. Trader's Way won't let me log in with the demo now.
If he does
interesting.
indicate that
it does.
the next meeting or two will be
it does,
a less
it does.
Aggressive rate of increases, maybe lower than the 75 basis points they've done in the last 3 meetings, plus probably what they'll do today. He'll also make it very clear that that is not necessarily followed by some sort of pause. A 50 basis point rate hike is still a very aggressive rate hike by any means. And so we are continuing to see them tightening. We are well into restrictive territory. We've seen, the 10-year, 3-month yield curve now invert for a few days. And they are continuing down this path. So I think if Jerome Powell is going to try to thread that needle, he will try to say, yes, we may go at a slower
it threw
pace,
me
but
in.
no, this does
I have to
not
do it
mean
again.
a pause is ahead. And for that pause to happen, of course, we'd need to hear what all the other panelists have talked about. Inflation rolling over, forward-looking indicators of inflation rolling over, which I think we're starting to see.
Yeah, the language could be clear, or it could be very, very, very subtle. Let's get to Kayla Tausche now with the Fed decision.
Okay, here we go.
Tyler, a 75 basis point increase by the Federal Reserve, bringing the target range for the Fed's benchmark interest rate to 3 3/4 to 4%. The decision for a fourth consecutive 75 basis point
got what we wanted.
was unanimous, but the statement does add a new flexibility on the pace of future rate increases. The Fed now says that it must pursue monetary policy that is, in its words, sufficiently restrictive to return inflation to its 2% target over time. The Fed now says that in determining the future path for interest rates, it will consider what it calls the cumulative tightening of monetary policy, and also
So it's being interpreted that they're going to pivot.
Actions and their impact on inflation and overall economic activity, acknowledging that there is a lag between the actions that it's taken to date and the impact that they've had on the economy so far, raising new questions about at what point the Fed could perhaps evaluate the impact of those actions and at what point they'll be fully baked in. Back to you.
All right, Kayla, thanks very much. We appreciate that.
Yeah, let's bring in our panel as we do see
S&P 500 up, U.S. dollar down. Totally makes sense.
15 points right now, 38.72. The Dow has just jumped 270 points. The NASDAQ and the NASDAQ 100 have turned positive as well. We're seeing yields come off in the Treasury market as well. The 10-year is hanging on to though just barely. Let's bring in our panel. Let's all bring our panel back in. Let's also add Steve Leisman, Bob Pisani, and Rick Santelli to the conversation. Steve, let's start with you and that change in language that Kayla just laid out.
Yeah, Kayla certainly highlighted the most important part right there. And it looks like there's two pieces to it. The first one here, in determining the pace of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity, inflation, and economic.
You doing all right?
So the first part, the part I didn't read, is they want to make sure it's sufficiently restrictive to return policy. So that tells you maybe they have more work to do. But the idea that maybe they're taking into account lag tells you maybe they're going to go slower here. I don't think I would mistake this for saying the Fed is ready to pause. I think it's something that you might digest and say the Fed is aware that it's done an awful lot and doesn't feel it has to do quite as much.
Okay, that's the first challenge. You see the top there?
While I'm talking here, what's happened to Fed fund futures?
The fractal's right at the top.
We'll see if that holds, but that May contract was trading at 503 for a high, for a peak funds rate. Now it's at 496. So not much of a change, but a little bit of coming off there. The market still is reading this, at least in the initial minutes after the statement came out, as believing the Fed has still considerable work that it will be doing. So maybe a slower pace, but I'm not seeing necessarily a lower peak.
Yeah, and yet it seems to be a slightly different story where equities are concerned right now, Bob Pisani. You got the Dow jumping to a 1% gain now. You got the S&P up 0.75%. The NASDAQ also moving higher, markedly higher as well. I mean, when you look at the equity markets, was it just spring-loaded for any teeny tiny sign, any little bit of hope that anything could be even the slightest bit more dovish than what we have seen previously?
Oh, this is more dovish than I think most people were expecting. I mean, when I called and said, is the Fed going to indicate any kind of pivot, any hint of anything? Not in a statement, maybe in the press release. That was the consensus. But look here, all right, Steve's right. This is not a pivot, but the committee will take into account the cumulative tightening of monetary policy. Hey, that's
what that means is they're assuming over time what they've already done will have an impact. You might not see it now, but they expect it over time.
On the press release, the press conference, excuse me, maybe he'll talk, more clearly coded words. He'll say two-sided risks or risks of slowing growth, something like that. But this is a fairly nice bone to throw to the bulls right now. I think the problem right now for the market is the job market's not cooperating. The JOLTS report, the ADP stronger, and people are afraid the Friday jobs report is going to be a lot stronger than expected. But look how far we've come here, guys. 3,900 on the S&P 500. We were at 3,550 just a couple of weeks ago. Dollar's a little bit lower. Two-year yields have flattened out a little bit, so it's understandable why the market has rallied. But this has really been very, very impressive right now. The problem for the market now is what else are they going to really say to get the market notably higher? We're already trading nearly 17 times forward earnings with no change in the
So we're going to watch the press conference in about 25 minutes, just so you know.
Already built into the market. But right now, this is about as much of a bone you're going to throw to the bulls as anyone would have expected, guys.
Rick Santelli, do you see it the same way? What is the bond market telling you about this language in the Fed statement?
Well, I'll tell you what, we knew it was going to either be a pause, pivot, or continue to punish, the three Ps. But I think they weaseled in a little bit and threw the markets a small bone. Granted, it's maybe the size of a window.
So I'm now at 200 pips.
I'm wrong. I didn't think they'd throw any bone. The wording as it was put forth and what I heard from Kayla and Steve, to me, sounds like they gave it a little wiggle room, which explains stocks. And the markets smelled it.
We
right.
just hit monthly S2, however.
And if you look at a two-year yield, it started to creep down. If you looked at the euro and the dollar index, the euro, well, it started to creep up. The dollar index started to creep down. Those are both very telltale signs that we're going to be a little less hawkish than maybe many anticipated. And I think when it comes to what the Fed's going to do, I think that anybody who discusses data dependent, I just don't agree with. I think the Fed, and just based on how their statement reads, They are looking at a spot down the road, and they change what that area may be. But truly,
No, guys, you're not looking
doesn't
for
seem to add up at this time.
double tops and
One
stuff.
further
You're
point
setting
I'd
up
like to make
situations in which
is
the
that
dollar will stay
continue to
weak till the
monitor
end of the year.
How much movement we get.
This is
that
not a
is
daily
causing
thing.
some of the
This is
numbers
fundamental,
into the
not
next
technical.
Fed meeting, whether it's Fed fund futures, which the moves are small, or the moves in the current Treasury complex where yields are moving down. It's certainly a different response to this meeting than the last several three-quarter point increases.
Mona, I want to bring you back in this conversation, get your reaction to this, not only this increase, but this change in language. In determining the pace of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity, and inflation and economic financial developments. I know we've already heard that read, but just to say it again, because it goes back to that conversation and the point that Rick just brought up about data dependency and the fact that now you're starting to see the Fed look at this and approach this maybe in a slightly different way than we've seen in the past, at least in terms of this statement. What does it mean? What do you think it tees us up for with that press?
Look at that,
conference?
almost lockstep, huh?
And just
This is the S&P 500 on the right.
It's interesting, Morgan. I think
Euro
they brought
dollar
up
on the
two
left.
points that we really haven't addressed or seen addressed from the Fed in the past. The first is the cumulative part, which, if you acknowledge, they started near the zero bound earlier this year. We're now at 4% on the Fed funds rate, or close to 4%. So they've already tightened this year cumulatively close to 400 basis points. In a given year, that is pretty unprecedented. And the second part of the statement that I think, again, perhaps a nod to the bulls, or at least those that are rooting for a slower pace of rate hikes, they're acknowledging the lag impact. In reality, or the Fed funds rate, there is about a 2 to 4 quarter lag from when the Fed tightens to when we see it hit the real economy. Now, some parts of the market and economy are very interest rate sensitive, and we are seeing housing, for example, perhaps the most interest rate sensitive part of the market, already showing signs of softening, weakening, perhaps even rolling over. Rental prices, which, as we all know, shelter and rent components of CPI have been sticking.
All right. So we'll wait for the press conference. Now it's just babble.
Certainly the Fed.
Is everything good? Okay. So again, right now the market's moving based on this trade plan that we set up last week. Let me say that again, last week. So now the issue is, can it sustain a higher high? Will you buy a higher low? We also have Bank of England tomorrow, non-farm payrolls. On Friday, we have the political election in the United States on Tuesday. Probably, inflation soon after that. I think the election's on the 8th. Inflation's usually closer to the 15th. Sky Killer says, why did it weaken? Because they hinted at a pivot. So what they're saying is, if you look at all the interest rate hikes they've already done, you won't see much of a change now. Inflation's still high. The economy's still red hot. But they believe the cumulative effects will slow the economy down, will reduce inflation in the near future. And therefore, they can slow down the pace of raising interest rates. Okay? So that's what that was. Remember, Sky Killer, you're never, ever, 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 ever trading a news release. You would never buy something because they just raised it by 75 basis points. We already knew that. So that's already done. That's not what's happening now. The fact is that they may be changing their policy is what might be happening now. But the fact they raised 75 basis points, we already knew that. So that's not what's going on here. So don't say, 75 basis points buy the dollar. No, we don't care about that. It's irrelevant at this point. Okay? So if they slow down the pace, and only raised by 50 basis points in December, then we need to price that in. And for those that are priced in another 75 basis points in December, that means the US dollar is overvalued because that's what was priced in. And now they'll have to adjust and say, it's not 75 basis points, it's 50 basis points. And so the US dollar weakens. Yeah, well, timing's everything, right, Sky Killer? So anywho, you have to decide, are you buying a dip or not? And you're like, but Wayne, how do I know? You don't know. That's why you have to decide now. See, the monthly S2 held on my peso trade. Oh, you're joining for the first time. Welcome. Glad to have you. Make sure you subscribe. Hey, I'm going to throw down an ad just to keep YouTube happy. So I apologize in advance. Oh, absolutely my pleasure. Oh, good. Joshi is a billionaire. 100% accuracy. That's amazing. Good for you. Oh, was it a political ad? Dr. H said it didn't show. Oh, good. Political ad though, huh? How very cool. Cool. Is it the Herschel Walker threatened to kill his wife ad? Oh, healthcare. Yeah, okay. No, we're not interested, Sonia. But thank you. Yeah. Yes, Charles. English pension funds had to do with the Bank of England selling US dollars. At the same time, the Bank of Japan and the People's Bank of China all selling dollars. Yeah, for sure. Thank you, Joshi. Yeah. Jonathan's like, hey man, I watched the Rogue Trader today. And it's hard to watch. It is hard to watch. Can I please save the video? Maybe. Why don't you just join fxbootcamp.com? It's $88 per year. And you can take an entire training course about this information. Why don't you just do that? Okay, I guess we can look around the world, see what else is going on, but you should, like, look, guys, you're looking at euro dollar and you're looking at S&P 500, and you're like, what's going on with gold? You should probably already know just by, you have enough information here to have a pretty good guess on what gold is doing. Okay. So let's take a look and see how let's see how it's doing. Okay. And gold is up. You had enough information to know that. Okay. Let's delete some of this stuff out. All right. Let's take a look at the world of gold. Gold has been sideways for quite a bit now since we double bottomed out, right? So we haven't been able to go lower. Right now, the top of the market is about where we are. Okay, 1630 is the bottom, 1666 is the top, projected top, likely top. But I think this could go higher. So I think ultimately if the dollar stays weak for the rest of November, and I think it very well could. It really could. In that case, the target is 1,750, let's say. Okay. So we're at, we can go up $100 on gold, let's say, in the next couple of weeks. Thank you, Six Dog. You're awesome. I don't know, Zach, but I think, that would need to be priced in. And that would probably be dollar strength. Okay. Ohio. In Ohio. Yeah, what if the midterm election year and all that? No, Darko, if you were going to short US dollar, you certainly need to get going now. And then see if and hope you can survive both non-farm payrolls and the election. So it'd be like hero or zero now. Okay, like I've been saying, if you're going to do it, you need to make that trade a couple of weeks before the election, and we're down to less than a week now. No, you're wrong. First of all, they did raise by 75 basis points. And then the next thing is the slowdown from 75 to 50 is dollar weakness, not dollar strength. Yeah, non-farm payrolls coming up. Yep, that's very interesting. Although I don't think it's critically important because the Fed has already given us a clue of what their change in policy is. So NFP is almost irrelevant now. Okay, they're slowing down to allow the cumulative effects of higher interest rates have an impact. So it's almost like they say they're not even interested in non-farm payrolls on Friday. You get that? Yeah. Okay, we're about 8 minutes away. Hope you're having fun. It's really nice to see you here in the afternoon. Ahmed says, where would the next buying opportunity for gold be? Assuming dollar weakness continues. You buy a dip. That's all you have to do now. Okay? Oh, my pleasure, Kev. Although for everybody in my day trading group, we usually meet at 4. That ain't going to happen today. Sorry. My back's already given out from sitting here for so long. Oh, thank you, Maida. Maida, you already gave me $2 yesterday. I tell you, you're too generous. Yeah, I'm telling you, we need to do a conference in Miami just so I can come down there and give you a hug. Yeah. And of course, I need to know sort of like the best Cuban restaurant in town. And then, of course, I'm going to need to go to a cigar bar. Yep. Cliche. I've become a cliche. It's all right. I remember, I don't know, 30 years ago, I went to a Cuban restaurant. I took a girl on a date, and there was a hole in the wall somewhere, and I'm like, I heard the food was good. We go in there, it's real simple, real modest. And the price for the thing I ordered a piece of beef. And it was quite expensive for me anyways. I was a young man at the time, but it was pretty expensive. The most expensive thing on the menu, I would imagine. And they brought it out to me, and it was just like a little piece of beef. It wasn't big at all, but it was square. I remember it being square. And then like some rice and black beans or something. And I'm like, what the heck? I paid way too much for this. Oh, but that piece of meat, they must have cooked it for 3 days, slow braising it. Oh, it melted in my mouth. It was fantastic. Yeah. Oh, thank you, Denise. All this money is going into my my wine account. Thank you for the Chateau Neuf de Pop. Jack says, you do a conference in the UK? I would definitely go. I would definitely go to the UK. In a heartbeat. Snap of the fingers, yep. You got to get 50 to 100 people together so I can cover my costs. Okay, how close are we? All right, we're pretty close. We're only a couple minutes away. Maida says no cigars. What? Ahmed says the UK weather is pretty grim at the minute. I don't care about the weather. All right, so where did my news stream go? What? Where did it go? Come on now. Just gone. All right, I guess I have to open it up again. I'll go back. Oh, you know what? I can do it on YouTube. So I have the Federal Reserve version. Let's do that. I'm over here. Of course, it wants full screen, not full window. It's interesting they block you from going on YouTube. Interesting. No music, huh? We're just sitting there. Oh, is it 11222? Interesting. Wow, such a small room, huh?
Good afternoon.
Oh, he's fired up.
My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools that we need and the resolve it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 75 basis points, and we continue to anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance of policy for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Real GDP rose at a pace of 2.6% last quarter, but is unchanged so far this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment.
Oh, he mentioned me.
Despite the slowdown in growth, the labor
Far
market
too
remains
kind.
extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 289,000 jobs per month over August and September. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in September, total PCE prices rose 6.2%, excluding the volatile food and energy categories. Core PCE prices rose 5.1%. And the recent inflation data again have come in higher than expected. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has created additional upward pressure on inflation. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency.
That looks
The longer
perfect,
the current
Maida.
bout of high inflation
Perfect.
continues, the greater the chance that
Perfect.
expectations of higher inflation will become entrenched.
That's what I want.
The Fed's
right
monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation.
That's it. That's where I'm going.
We are highly attentive to the risks that
Breakfast,
high
lunch,
inflation
and dinner.
poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 75 basis points. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. With today's action, we've raised interest rates by 3.75 percentage points this year. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Financial conditions have tightened significantly in response to our policy actions.
Yeah.
We are seeing
No,
the
I'm
effects
ready.
on
That's
demand
it.
in the most interest rate sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. That's why we say in our statement that in determining the pace of future increases in the target range, we will take into
See, I want to
account
go there, have
cumulative
Cuban
tightening
coffee
of
and a
monetary
cigar for
policy
breakfast.
And the lags with which monetary policy affects economic activity and inflation. At some point, as I've said in the last two press conferences, it will become appropriate to slow the pace of increases as we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal. There is significant uncertainty around that level of interest rates. Even so, we still have some ways to go, and incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible.
See, I'm even checking the menu to see if they offer
Taking
cigars.
forceful
I don't think they
steps
do,
to
though.
moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices.
Let's just see how they're reacting to what he's saying.
The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done.
Aha! He's talking about the
To
70s.
conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public.
So what he just said is that they will have the strength to keep raising, keep raising, keep raising.
Price stability goals.
He basically, I think he just told us that the terminal rate is higher than people think. That they're not going to pause. They might slow down, but they're not thinking about pausing.
Questions?
All right, here we go.
Thank you. Colby Smith with the Financial Times. On the need to slow the pace of rate increases at some point, is a downshift contingent on a string of better inflation data specifically between now and, let's say, the December meeting? Or is that something that the Fed could potentially proceed with independent of that data, given the lagged effects that you mentioned?
So a couple things on that. We do need to see inflation coming down decisively, and good evidence of that would be
Yeah,
a
Zach did
series
nail
of
it.
down monthly readings.
He nailed
Of
it.
course, that's what we'd all love to see, but I've never thought of that as the appropriate test for slowing the pace of increases or for identifying the
That's
appropriate
very
restrictive
possible
level
at
that we're aiming for.
EDUX or EDX
We need
or
to bring our policy stance
EDUX,
down to a level
EDUX.
that's sufficiently restrictive to bring inflation down to our 2% objective over the medium
But
term.
don't force
How will
it
we know
until
that
it's
we've reached that
technically
level? Well,
been
we'll
confirmed.
take into account the full range of analysis and data that bear on that question, guided by our assessment of how much financial conditions have tightened, the effects that tightening is actually having on the real economy and on inflation, taking into consideration lags, as I mentioned. We will be looking at real rates, for example, all across the yield curve and all other financial conditions, and as we make that assessment.
Hi, Howard Schneider with Reuters. Look, I'm sure there's going to be tons of confusion out there about whether this means you're going to slow in December or not. Would you say that the bias right now is not for another 75 basis point increase?
So, what I want to do is
You can't
put
answer that.
question of pace in the context of our broader tightening program, if I may, and hit to talk about the statement language along the way. So I think you can think about our tightening program as really addressing three questions. The first of which was, and has been, how fast to go. The second is how high to raise our policy rate. And the third will be eventually how long to remain at a restrictive level. So on the first question, how fast to tighten policy, it's been very important that we move expeditiously, and we have clearly done so. We've moved 3 3/4% since March, admittedly from a base of 0. It's a historically fast pace, and that's certainly appropriate, given the persistence and strength in inflation and the low level from which we started. So now we come to the second question, which is how high to raise our policy
Pay attention.
rate. And we're saying that we'd raise that rate to a level that's sufficiently restrictive to bring inflation to our 2% target over time, and we put that into our post-meeting statement. Because that really does become the important question we think now is how far to go, and I'll talk more about that. We think there's some ground to cover but before we meet that test, and that's why we say that ongoing rate increases will be appropriate. And as I mentioned, incoming data between the meetings, both the strong labor market report, but particularly the CPI report, do suggest to me that we may ultimately move to higher levels than we thought at the time of the September meeting. That level is very uncertain, though, and I would say, we're going to find it over time. Of course, with the lags between policy and economic activity, there's a lot of uncertainty. So we note that in determining the pace of future increases, we'll take into account the cumulative tightening of monetary policy as well as the lags with which monetary policy affects economic activity and inflation. So I would say as we come closer to that level, move more into restrictive territory, the question of speed becomes less important than the second and third questions. And that's why I've said at the last two press conferences that at some point it will become appropriate to slow the pace of increases. So that time is coming, and it may come as soon as the next meeting or the one after that. No decision has been made. It is likely we'll have a discussion about this at the next meeting, a discussion. To be clear, let me say again, the question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restricted, which really will be our principal focus.
If I could follow up on that, to what degree was there an importance or weight given to a need to signal this possibility now, given all the concerns really around the globe about...
He's going to get a haircut
policies
tomorrow. He was just too
riding ahead,
busy before the meeting.
And everybody else, dealing with their own stress as a result.
Well, I think I'm pleased that we have moved as fast as we have. I don't think we've over-tightened. I think there's very difficult to make a case that our current level is too tight, given that inflation still runs well above the federal funds rate. So I think that at this meeting, the last two meetings, as I've mentioned, I've said that there would come a point, and this was a meeting at which we had a discussion about what that might mean, and we did discuss this, and as I mentioned, we'll discuss it again in December. But there's I don't have any sense that we've over-tightened or moved too fast. I think it's been good and a successful program. That we've gotten this far this fast. Remember though that we still think there's a need for ongoing rate increases, and we have some ground left to cover here, and cover it we will.
Nick Temeros of the Wall Street Journal. Chair Powell, core PCE inflation on a 3 or 6 month annualized basis and on a 12-month basis has been running in the high fours, close to 5%. Is there any reason to think you won't have to raise rates at least above that level to be confident that you are imparting enough restraint to bring
I think I'm
inflation
connected
down?
with this guy on LinkedIn.
So this is the question of does the policy rate need to get above the inflation rate? And I would say there are a range of views on that. That's the classic Taylor principle view. But I would think you'd look more at a forward-looking measure of inflation to look at that. But I think the answer is we'll want to get the policy rate to a level where it is where the real interest rate is positive. We will want to do that. I do not think of it as the single and only touchstone, though. I think you put some weight on that. You also put some weight on rates across the curve. Very few people borrow at the short end at the federal funds rate, for example. So households and businesses, if they're very meaningfully positive interest rates all across the curve for them, credit spreads are larger, so borrowing rates are significantly higher, and I think financial conditions have tightened.
You guys doing okay?
So I would look at that as an important feature. I'd put some weight on it, but I wouldn't say it's something that is the single dominant thing to look at.
If I could follow up, what is your best assessment or the staff's best assessment right now of the current rate of underlying inflation?
I don't have a specific number for you there. There are many, many models that look at that. And I mean, one way to look at it is that it's a pretty stationary object, and that when inflation runs above that level, for sure, substantially above for some time, you'll see it move up, but the movement will be fairly gradual. So I think that's what the principal models would tend to say. But I wouldn't want to land on any one assessment. There are many different, as you know, different people who publish an assessment of
Mojito and grilled octopus sounds good right now.
Hi, Chair Powell. Thank you for taking our questions. Gina Smilek, New York Times. I wonder, do you see any evidence at this stage that inflation is or is at risk of becoming entrenched?
Is inflation becoming entrenched? So I guess I would start by pointing to expectations. So if we saw longer term expectations moving up, that would be very troubling. And they were moving up a little bit at the middle part of this year, and they've moved now back down. That's one piece of data. Shorter term inflation expectations moved up between the last meeting and this meeting. And we don't think those are as indicative, but they may be important in the wage setting process. There's a school of thought.
Well, that's right, Peter. So he's saying that they might be slowing down, but they're not stopping.
That the longer,
and that he even said even they think they need to go higher than they originally thought. So that is definitely on the bullish side, for sure. For sure. For sure. Okay, I'm down to 188 pips now on my gold. Remember, it was 200. Some ground left to cover for sure.
18 months into this episode of high inflation, and we don't have a clearly identified scientific way of understanding at what point inflation becomes entrenched. And so the thing we need to do from a risk management standpoint is to use our tools forcefully but thoughtfully and get inflation under control, get it down to 2%, get it behind us. That's what we really need to do.
Well, of course, we don't know how high because they don't know how high. But that's dollar bullish
Hi,
for sure.
Thank you for taking our questions. Rachel Siegel from the Washington Post. The statement points to lag times. I'm wondering if you can walk us through how you judge those lag effects, what that timeline looks like over the coming months or even a year, and where you would expect it to show up in different parts of the economy.
Yeah, so the way I would think about that is it's a commonly, for a long time, thought that monetary policy works with long and variable lags, and that it works first on financial conditions and then on economic activity, and then perhaps later than that even on inflation. So that's been the thinking for a long time. There was an old literature that made those lags out to be fairly long. There's newer literature that says that they're shorter. And the truth is we don't have a lot of data of inflation of this high in what is now the modern economy. One big difference now is that...
Well, what he's trying to say is there's two different types of
we would raise
inflation.
the federal funds rate, financial conditions would react. And
The
then
Bank
that
of
would
Japan
affect
is already
economic
doing
activity
stuff
and
about
inflation.
that.
Now, financial conditions react well before, in expectation of monetary policy. That's the way it has moved for a quarter of a century, is in the direction of financial conditions, then monetary policy, because the markets are thinking what is the central bank going to do. And there are plenty of economists that also think that once financial conditions change, that the effects on the economy are actually faster than they would have been before. We don't know that. I guess the thing I would say is it's highly uncertain. And so from risk
So anyways,
management,
there's the last
it would be
75
irresponsible
basis
not
point hike.
to ignore them, but you want to consider them. But
That's
not-
the last
not take them
one,
literally.
y'all.
So I think it's a very difficult place to be. But
I still
tend to
think
be
we're on
in
our
the-
way to 5
in the
1/4.
middle, looking carefully at what's actually happening with the economy, and trying to make good decisions from a risk management standpoint. Remembering, of course, that
Let's take a look around the world.
If we were to over tighten, we could then use our tools strongly to support the economy. Whereas if we don't get inflation under control because we don't tighten enough, now we're in a situation where inflation will become entrenched, and the costs, the employment costs in particular, will be much higher potentially. So from a risk management standpoint, we want to be sure that we don't make the mistake of either failing to tighten enough or loosening policy too soon.
And if I could follow up, should we interpret the addition to the statement to mean that more weight is put into those lag effects than they would have been after previous rate hikes?
So I think as we move now into...
See, if we go below this plan that I did last week,
these ongoing rate hikes and policy becomes
that would
more
suggest
restrictive,
ongoing dollar
it'll
strength.
be appropriate now to be thinking more about lag. Of course, we think about the lags are just sort of a basic part of monetary policy, but we will be thinking about them. But we won't be, I think we'll be considering them, but because it's appropriate to do so. Let me say this: it's it is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. It's very premature, in my view, to think about or be talking about pausing our rate hike. We have a ways to go. Our policy, we need ongoing rate hikes to get to that level of sufficiently restrictive, and we don't, of course, we don't really know exactly where that is. We have a sense, and we'll write down in the December meeting, a new summary of economic projections, which updates that. But I would expect us to continue to update it based on what we're seeing with incoming data.
Thanks, Chair Powell. Neil Irwin with Axios. As you look around the economy, the clearest impact of your tightening so far has been on housing, maybe some venture-funded tech companies. It's been relatively narrow in terms of the labor market, consumer demand, a lot of sectors you don't see a ton of effect. Is the pathway and channels through which monetary policy works changing? Is it narrower than it used to be? And on housing in particular, are you at all worried that you're crimping housing supply in ways that might cause problems down the road?
I don't know that the channels through which policy works have changed that much. I would say a big channel is the labor market, and the labor market is just very, very strong, very strong. And households, of course, have strong balance sheets. And so we go into this with a strong labor market and excess demand in the labor market, as you can see through many different things, and also with households who have strong spending power built up. So it may take time. It may take resolve. It may take patience. It's likely to get inflation down. I think you see from our forecasts and others that it will take some time for inflation to come down. It'll take time, we think. So, sorry, was I getting to your question there? Oh, housing, the housing part of it. Yeah, so, we look at housing. Of course, housing is significantly affected by these higher rates, which are really back where they were before the global financial crisis. They're not historically high, but they're much higher than they've been. And you're seeing housing activity decline, and you're seeing housing prices growing at a faster rate, and in some parts of the country declining. I would say the housing market was very overheated for the couple of years after the pandemic as demand increased and rates were low. We all know the stories of how overheated the housing market was, prices going up, many bidders, no conditions, that kind of thing. So the housing market needs to get back into a balance between supply and demand. We're well aware of what's going on there. From a financial stability standpoint, we didn't see in this cycle the kinds of poor credit underwriting that we saw before the global financial crisis. Housing credit was very much more carefully managed by the lenders. So it's a very different situation and doesn't appear to present financial stability issues. But no, we do understand that that's really where a very big effect of our policies is.
Hi, Victoria Guida with Politico. I wanted to ask about the labor market. You mentioned early on again that job openings are very high compared to available workers, and I'm just curious to what extent you do and don't draw a signal from that. So, for example, if wage growth is slowing and if maybe the unemployment rate starts to tick up, will that make you sort of decrease your focus on job openings? What do you see? Are wages what's really important? How are you thinking about the labor market as it relates to inflation?
So we talk a lot about vacancies and the vacancy to unemployed rate, but it's just one. It's just another data series. It's been unusually important in this cycle because it's been so out of line. But so has quits, so have wages. So we look at a very wide range of data on the labor market. So I'd start with unemployment, which is typically the single statistic you would look to, is at a 50-year low, 3.5%. We're getting really nothing in labor supply now. We had, I think, a very small increase this year, which we had really thought we would get that back. Most analysts thought we would get some labor supply coming in. You mentioned wages, so I guess I would characterize.
All right, Meta, there's a nice cigar bar 3 blocks away from the restaurant.
I would call it a flattening out at a level that's
huge outdoor patio.
Level that would be consistent over time with 2% inflation, assuming a reasonable productivity. There with the ECI reading this week, again a mixed picture. The headline number was a disappointment. Let's just say it was high. It didn't show a decline. There's some rays of light inside, that if you look at private sector workers, that did come down, the compensation did come down. But overall, though, the broader picture is of an overheated labor market where demand substantially exceeds supply. Job creation still exceeds, the sort of the level that would hold the market where it is. So that's the picture. Do we see? We keep looking for signs that sort of the beginning of a gradual softening is happening. And maybe that's there, but it's not. It's not obvious to me because wages aren't coming down; they're just moving sideways at an elevated level, both ECI and average hourly earnings. We want to see. We would love to see vacancies coming down, quits coming down. They are coming down. Vacancies are below their all-time high, but not by as much as we thought because, and that the data series is volatile. We never take any one reading. We always look at 2 or 3. So it's a mixed picture. I don't see the case for real softening just yet, but we look at, I guess as I just showed you, we look at a very broad range of data on the labor market.
So do you see wages as being a significant driver of inflation?
I think wages have an effect on inflation, and inflation has an effect on wages. I think that's always been the case. There's always a going back and forth. The question is that really elevated right now? I don't think so. I don't think wages are the principal story of why prices are going up. I don't think that. I also don't think that we see a wage price spiral. But again, it's not something you can, once you see it, you're in trouble. So we don't want to see it. We want wages to go up. We just want them to go up at a level that's sustainable and consistent with 2% inflation. And we do think that given the data that we have, that this labor market can soften without having to soften as much as history would indicate through the unemployment channel. It can soften through job openings declining. We think there's room for that, but we won't know that. That'll be discovered empirically.
Thank you so much. Kayla Tausche from CNBC. Earlier last month, the United Nations warned that there could be a global recession if central banks didn't change course. The new UK Prime Minister warned of a profound economic crisis there. And I'm wondering how the Fed is weighing international developments in light of a very strong economy here in the US that would seem to be bucking those trends.
So, of course, we keep close tabs on economic developments and also geopolitical developments that are relevant to the economy abroad. We're in very frequent contact with our foreign counterparts, both through the IMF meetings and the regular meetings with central banks that we have, and I have one this weekend with many central bankers. So we're in touch with all of that. So I guess it's clearly a difficult time in the global economy. We're seeing very high inflation in Europe, significantly because of high energy prices related to the war in Ukraine, and we're seeing China's having issues with the zero COVID policy and much slower growth than we're used to seeing. So we see those difficulties. The strong dollar is a challenge for some countries, but we take all of that into account in our models. We think about the spillovers and that sort of thing. Here in the United States, we have a strong economy, and we have an economy where inflation is running at 5%. Core PCE inflation, which is a really good indicator of what's going on for us, is the way we see it, is running at 5.1% on a 12-month basis and sort of similar to that on a 3, 6, and 9-month basis. So we know that we need to use our tools to get inflation under control. The world's not going to be better off if we fail to do that. That's a task we need to do. Price stability in the United States is a good thing for the global economy over a long period of time. Price stability is the kind of thing that pays dividends for our economy for decades, hopefully. Even though it may be difficult to get it back, getting it back is something that provides value to the people we serve for the long run.
If I could just follow up on that. Thank you. The Fed has acknowledged in the past that that the tools that you have don't affect things like energy and food prices that stem from some of those conflicts overseas, and they're some of the biggest pain points for consumers. So as you pursue the current path that you've outlined, is there a risk that some of those prices simply don't come down?
So we don't directly affect, for the most part, food and energy prices, but the demand channel does affect them just at the margin. The thing about the United States is that we also have strong, in many other jurisdictions, the principal problem really is energy. In the United States, we also have a demand issue. We've got an imbalance between demand and supply, which you see in many parts of the economy. So our tools are well suited to work on that problem, and that's what we're doing. You're right, though. We don't, the price of oil is set globally, and it's not something we can affect. I think by the actions that we take, though, we help keep longer-term inflation expectations anchored, and keep the public believing in 2% inflation by the things that we do, even in times when energy is part of the story of why inflation is high.
Hi, Chair Powell, Janelle Marti with Bloomberg. So the Fed is facing two more ethics-related incidents with the revision of the financial statements from President Bostic and President Bullard speaking at a closed event. So some senators, like Elizabeth Warren, are saying that this is a sign of greater ethics problems at the Fed. Could you talk about what this does to the public's trust in the bank and what the Fed is doing to prevent this kind of behavior from becoming common?
Sure. So you're right. The public's trust is really the Fed's and any central bank's most important asset. And anytime one of the policymakers violates or falls short of those rules, we do risk undermining that trust. And we take that very seriously. We do. So at the beginning of our meeting yesterday, actually, we had a committee discussion of the full committee on the importance of holding ourselves individually and collectively accountable for knowing and following the high standard that's set out in our existing rules with respect to both personal investment activities and external communications. We've taken a number of steps, and I would just say we do understand how important those issues are. I would say that our new investment program that we have is up now and running, and actually it was through that the problems with President Bostic's disclosures were discovered when he filed his new disclosures. That's, we now have a central group here at the Board of Governors that looks into disclosures and follows them and approves people's disclosures, and also all of their trades. Any trade anyone has to make who's covered has to be pre-approved. And there's a lag. It has to be pre-approved 45 days before it happens, so there's no ability to game market. So it's a really good system. It worked here. And I think we all said to each other yesterday morning, we recommitted to each other and to this institution to hold ourselves to the highest standards and avoid these problems.
Do you have an update on the investigations that are pending?
I don't. So, as you know, I referred the matter concerning President Bostic to the Inspector General. And once that happens, I don't discuss it with the Inspector General, with anybody. It's just the Inspector General has the ability to do investigations. We don't really have that. So that's what he's doing.
Michael McKee from Bloomberg Television.
All right, listen to Mike. He's
Earlier
good.
this year, you touted the 3-month bill yield out to 18 months as the yield curve with 100% explanatory power. And you said, quote, if it's inverted, that means the Fed's going to cut, which means the economy is weak. That curve is only 2 basis points away from inversion now. So I'm wondering why you are so confident that you have not over-tightened, particularly given that rates work with a lag.
Well, so we do monitor the near-term forward spread. You're right, and that's been our preferred measure. We think it, just empirically, it dominates the ones that people tend to look at, which is 2s, 10s, and things like that. So it's not inverted. And also, you have to look at why why the rate curve is doing what it's doing. It can be doing that because it expects cuts, or because it expects inflation to come down. In this case, if you're in a situation where the markets are pricing in significant declines in inflation, that's going to affect the forward curve. So yes, we monitor it. You're right, and that's what I would say.
Follow up.
Yep.
You also
Yep.
said several
Yep.
meetings ago that the risk of doing too little outweighed the risk of doing too much. Is what you're trying to tell us today is that that risk assessment has
Yep.
changed a little
Yep.
bit?
Yep, that's what we
Well,
think.
what's happened is time has passed and we've raised interest rates by 375 basis points. I would not change a word in that statement, though. I think until we get inflation down, you'll be hearing that from me. Again, if we over tighten, and we don't want to, we want to get this exactly right. But if we over tighten, then we have the ability with our tools, which are powerful, to, as we showed at the beginning of the pandemic episode, we can support economic activity strongly if that happens, if that's necessary. On the other hand, if you make the mistake in the other direction and you let this drag on, then it's a year or two down the road and you're realizing inflation behaving the way it can, you're realizing that you didn't actually get it, you have to go back in. By then, the risk really is that it has become entrenched in people's thinking, and the record is that the employment costs, the cost to the people that we don't want to hurt, they go up with the passage of time. That's really how I look at it. So that isn't going to change. What has changed, though, you're right, is we're farther along now, and I think as we're farther along, we're now focused on that. What's the level we need to get to rates, and I don't know what we'll do when we get there. By the way, we'll have to see. There's been no decision or discussion around exactly what steps we would take at that point, but the first thing is to find your way there.
Thank you. Chris Rugaber at Associated Press. Just to go back to housing for a minute, you mentioned the impact that rate increases have had on housing. Home sales are down 25% in the past year and so forth, but none of this is really showing up, as you know, in the government's inflation measures. And as we go forward, private real-time data is clearly showing these hits to housing. Are you going to need to put a greater weight on that in order to ascertain things like whether there's over-tightening going on? Or will you still focus as much on the more lagging government indicators?
So this is an interesting subject. So I start by saying, I guess, that the measure that's in the CPI and the PCE, it captures rents for all tenants, not just new leases. And that makes sense, actually, because that for that reason, that conceptually, that's sort of the right target for monetary policy. And the same thing is true for owner's equivalent rent, which comes off of it's a reweighting of tenant rents. The private measures are of course good at picking up the at the margin the new leases, and they tell you a couple things. One thing is I think right now, if you look at the pattern of that series of the new leases, it's very pro-cyclical. So rents went up much more than the CPI and PCE rents did, and now they're coming down faster. So the implication is that there are still, as non-new leases roll over and become and expire, right? There's still in the pipeline, there's still some significant rate increases coming, okay? But at some point, once you get through that, the new leases are going to tell you that what they're telling you is there will come a point at which rent inflation will start to come down. But that point is well out from where we are now. So we're well aware of that, of course, and we look at it. And but I would say that in terms of what the right way to think about inflation really is to look at the measure that we do look at, but considering that we also know that at some point you'll see rents coming down.
Great. And just a quick follow. It looks like stock and bond markets are reacting positively to your announcement so far. Is that something you wanted to see? Is that a problem, or how that might affect your future policy to see this positive reaction?
We're not targeting any one or two particular things. Our message should be, what I'm trying to do is make sure that our message is clear, which is that we think we have a ways to go. We have some ground to cover with interest rates before we get to that level.
So
of
far, it's
interest
still
rates that we
holding.
think is sufficiently restrictive. And putting that in the statement and identifying that as a goal is an important step. And that's meant to put that question really as the important one now going forward. I've also said that we think that the level of rates that we estimated in September, the incoming data suggests that that's actually going to be higher. And that's been the pattern. I mean, I would have little confidence that the forecast, if we made a forecast today, if we were doing an SEP today, the pattern has been that one after another, they go up, and, that'll end when it ends. But there's no sense that inflation is coming down. It just, if you look at I have a table of the last 12 months of 12-month readings, and there's really no pattern there. We're exactly where we were a year ago. So, okay. So I would also say it's premature to discuss pausing, and it's not something that we're thinking about. That's really not a conversation to be had now. We have a ways to go. And the last thing I'll say is that I would want people to understand our commitment to getting this done, and to not making the mistake of not doing enough, or the mistake of withdrawing our strong policy and doing that too soon. So I control those messages, and that's my job.
Yep. He's so funny today.
Edward Lawrence with Fox Business. Thank you, Fed Chairman. So how big of a headwind is all the fiscal spending to what the Federal Reserve is trying to do to get inflation back to the 2% target?
In theory, it was a headwind this year, but I do think the broader context is that you have households that have these significant amounts of savings and can keep spending. I think those two things do tend to sort of counterbalance each other out. It appears consumer spending is still positive. It's at pretty modest growth levels. It's not shrinking, but people are, the banks that deal with retail customers and many retailers will tell you that the consumers are still buying, and they're still they're fine. So I don't know how big the fiscal headwinds are, and they haven't shown up in the way that we thought they would in restraining spending. So it must have to do with the savings that people have.
What about the spending? There's tens of billions yet to be spent. I mean, from the Inflation Reduction Act, the American Rescue Plan, CHIPS Act, bipartisan infrastructure bill. How does that play into your thinking about the future?
It's demand is going to have some support from those savings, and also from the strong demand that's still in the labor market. We still see pretty significant demand and a tightening labor market in some respects, although I think overall I would say it's not really tightening or loosening. So we see those things, and what those things tell us is that our job is going to require some resolve and some patience over time. We're going to have to stick with this. That's just we take all that as a given, but we know what our objective is, and we know what our tools can do, and that's how we think about it.
Yep.
Hi, Chair Powell. Nancy Marshall-Genzer from Marketplace. I'm wondering, has the window for a soft landing narrowed? Do you still think it's possible?
Has it narrowed? Yes. Is it still possible? Yes. I think we've always said it was going to be difficult, but I think to the extent rates have to go higher and stay higher for longer, it becomes harder to see the path. It's narrowed. I would say the path has narrowed over the course of the last year, really. Hard to say. Again, I would say that the sort of array of data in the labor market is highly unusual, and to many economists, there is a path to. Ordinarily, there's a relationship to GDP going down and vacancies declining, translating into unemployment, or there's Okun's law. So all those things are relationships that are in the data, and they're very real. Data's a little bit different this time, though, because you have this tremendously high level of vacancies, and we think on a very steep part of the beverage curve. All I would say is that the job losses may turn out to be less than would be indicated by those traditional measures because job openings are so elevated and because the labor market is so strong. Again, that's going to be something we discover empirically. I think no one knows whether there's going to be a recession or not. And if so, how bad that recession would be. And, our job is to restore price stability so that we can have a strong labor market that benefits all over time. And that's what we're going to do.
But just real quickly, why do you feel like the window has narrowed?
Because we haven't seen inflation coming down. The implication of inflation not coming down, and what we would expect by now to have seen is that as the supply side problems had resolved themselves, we would have expected goods inflation to come down by now, long since by now, and it really hasn't. Although it has come down, but it's not to the extent we had hoped. At the same time, now you see services inflation, core services inflation moving up, and I just think that the inflation picture has become more and more challenging over the course of this year, without question. That means that we have to have policy be more restrictive, and that narrows the path to a soft landing, I would say. Thanks very much.
I guess that's it. All right. Slower for longer. Market's going to battle it out. Speed is one thing, but ultimately what we are looking for is the terminal rate. And they said the interpretation here is that they're not going to raise by 75 basis points in December, that they're going to slow down. They're going to allow the cumulative effects to catch up. But they're not even thinking about projecting a terminal rate. So it could just, they drop to 50 basis points for a couple of meetings and then 25 basis points for a few meetings. So, yeah. So that means, yes, slowing down the rate, but probably increasing the terminal rate. So my guess would be dollar strength. Isn't that interesting? So thank you for being here today. Would you please click the thumbs up button? Just tell YouTube that this was pretty good stuff. It was aight. If you're new, why don't you join fxbootcamp.com? It's $88 a year. Come on. Join. We have a community here. Yeah. So anyways, thank you. Big round of applause to everybody. Thank you for being here. I'll see you tomorrow morning. Please subscribe to Forex.Today. And I will see you tomorrow. Fingers crossed we maintain trend on US dollar strength. That's what has been happening. And after all this time, that seems to be the end result. Cheers.